Hello everyone, and thanks for tuning in to the Financial Investor channel. My name is Brent. Today we're going to be covering 5 stocks with ex-dividends next week. Now I'm going to be trying to get through this really quick. We're going to be talking about whether they're overvalued, are they undervalued, whether their 1-year growth, 5-year growth, their payout history, their payout percent, how much they're paying out to their shareholders, how much they're taking of their earnings and reinvesting into their company, taking a look at their dividend history. Can they continue to pay out during recessions, or do they drop it, or do they just stop increasing it and just kind of continue paying out? So let's go ahead and take a look at 5 stocks. Of course, if you are brand new to my channel, I do make stock market and investment videos daily, so do consider subscribing. I do make ex-dividend videos just about every single Wednesday. These are videos that I like to make just because I like to have a vision of different stocks that I may not be investing in. But at the same time, these random stocks, there's always 5 that come up in the next week, and I like to take a look at them. So hopefully these are fun. So our first ticker symbol is WMB, Williams Company. So WMB, this is an energy-based company in Oklahoma. Its core business is natural gas and processing and transportation. So taking a look at its 3-year here. It's very sporadic. Let's take away its dividend. We can see that its price is in the blue. Its price is in the $55 range. It has a sharp decline in the middle of 2015 and just did not stop until 2016. 2016, and then kind of rose up again and has been kind of having a support of around $29. But this could go either way. It could go up, it could go down. Its dividend yield, on the other hand, is on a downwards trend. Now, it looks like they've been decreasing. Even though their stock has been pretty stale and not moving in price very often, their dividend yield has been decreasing from 7.5 to 3.43. So this could be due to the dividend being cut. So take a look at their dividend and price. We can see that their price is in the orange now, and that their dividend, the blue line, follows along with their price. So if their stock is priced really well, they pay out really well. If their price gets cut or just tumbles, they cut their dividend payout and it tumbles. And then here in 2016, they had a flat period here and then rose it again in 2017. So this is a very unpredictable stock as far as where its value is at, and that could be due to a stock split, but we're going to investigate that. So WMB, this stock its ex-dividend is next Thursday on the 7th, so you must purchase this on Wednesday in order to be eligible for the payout on the 25th. So this company is in the sort of gray, very weird. For its 1 day, it looks like it didn't move. This could be one that they eventually... I'm not going to go ahead and I'm not sure. I haven't done a full assessment of this stock. We're just sort of covering this, whether its ex-dividend is next week, or yes, next week. Price to earnings really high, 47.8. Dividend yield 4.11. 1 year it's up 4.14. 5 year it's down 9.61. So not a great buy and hold investment. Especially with these swings, you don't know where the heck it's going to go. As we said, 2016 July, or 2015 July, it's just been on a downwards trend. Bottomed out February 2016, has actually had an increase of 116%. So depending on your buying point, this could be a good investment, but right now we have no idea where it's going to be going. It's been trailing sideways for over a year now, September to August. So it's going to be trailing sideways nearly a year now. It's actually on a negative trailing sideways right now. So not a good buy and hold for the long term, I don't believe. WMB, I spelled that wrong. WMB. Take a look at its payout. That's always important. Payout ratio 162%, which means this company could be going under here shortly. Dividend growth hasn't had any. Of course, we already covered you have to buy and hold it on Wednesday into Thursday, so you can hold it for the ex-dividend date, which is on the 7th, which is Thursday. They've had negative growth for the past 2016 to 2017, had negative 31.4%. So they actually cut their ex-dividend or their dividend pay from 64 cents to 20 cents. So huge cut there. They do offer qualified dividends, just meaning that you would only get taxed at the dividend rate of 15%, whereas other ones that aren't qualified would be taxed at your regular tax income rate. So in my assessment here, this would not be a good buy and hold for the long term, just because we don't know. This stock is unpredictable. It's been trailing sideways. It could fall again, and its 5-year and 1-year are not amazing. Nothing that you would want to buy and hold for the long term. You know, there are much better investments out there than Williams, and their payout ratio is terrible. So next company is Eat. So this is Chili's and Maggiano's Italian restaurant chain. And let's go ahead and bring in the yield back in here and take a look at its price and yield. So its yield is 4.3%. So this is really high right now. This is actually one of the highest points in its history. No, actually in its history, I was back here in 2009, had a yield of 8.43%, so very high. So let's just take a look at the 5-year here. So in the last 5 years, we're at a dividend history or dividend payout of 4.3%, so very high. Stock price 31.63, but at the same time, it is trending downwards. We don't know where it's going to bottom out at. The last time it was this low was in 2013. So very unpredictable stock. Let's go ahead and take a look at its dividend and price. So had during 2008, it froze their dividend increase and then had increased it ever since then. So during times of recessions, this isn't recession proof. They would actually lock their dividend pay and continue to pay out the same dividend payout, but they would not increase it. So let's go look at their 1 year and 5 years. So Eat stock. So 1 year is down 40%. 5 year, they are up. Oh, actually down 8.21%. Did not expect that. It looked just about even. Oh, this one's a little bit higher. Okay. So not a great long-term investment. So terrible week for pickers right now for dividend stocks. For our 5 stocks with ex-dividends next week, we are not looking too amazing right now. We've picked 2. Well, I've picked 2 losers so far. So let's take a look at their payout ratio. Hopefully this one has a much better payout ratio. You know, if this one in the year, if this could bottom out here at $31, that would be a good entry point. Look at this. The last time it was $31 was right here. Where was that 0.16? Right here in 2012. So 5 years ago, it was at the same price it is now. And that could be due to a stock split. I'm just going to take a quick look in here. If there's a stock split, there was in 2007. They did 3-for-1, so they increased their dividend payout by 50%. So they didn't cut it. They actually increased their dividend too. Nice. Okay. So what are we seeing here? So not a lot of growth in the 1 year, and they're down in the 5 year. So not a great long-term buy and hold. Payout ratio is under 60, so not terribly bad on the payout ratio. They have had dividend growth for the past 6 years, which means they haven't paid out through a recession. We saw that they didn't cut their payout, but they didn't increase it either, and that could be due to that stock split. So not terrible. Ex-dividend is next Thursday again, so you need to buy and hold it through Wednesday. You need to buy it Wednesday and hold it into the following day. Their annual growth is 10%, so nice growth. I like to see growth higher than 5 to 8%. So, or I like to have growth 5 to 8% depending on the yield. This has growth of 10%, so that's very nice and consecutive for the 6 years. Now we can see that there was a stock split here where they did 3-for-2. Normally it's 2-for-1 or 3-for-1, where it would basically double or triple your dividend payout. They did a 3-for-2, which would basically it wouldn't double your payout, it increased your payout by 50%. So if you were getting $100 in dividend payout per year, you would now get $150. Whereas if you did a 2-for-1, instead of $100 per year, you would make $200 per year. So that's what they did there. But they also increased their dividend from 0.06 to 0.09. So they had nice growth. Now they did hold during the recession 2008, but because the stock split, you didn't care. You held the stock, and you got paid that 11 cents per share at what was assumed a really nice price, $31 right now. What was it in 2000? What was it? 8? Let's see. What was it? 2008. It was $35. So I mean, during times of recession, look at this. What was it? 92. There was a recession. This one didn't get affected. 98. There was a recession in 98. This one, oh no, not 98. There was a recession in 2000. This one didn't even get tripped up by that 2000 recession. This one just kept climbing. 2008 recession. This one did get hit, fell down 88%, but it did recover it within a time frame of roughly, right in here, roughly 6 years. It took about 6 years to recover from their loss. But during this recession, they continued to pay out dividends. They didn't cut them. They just didn't continue. They didn't raise them, and then they started to raise them in 2008 or 2010, and then have continued to do so. So not a terrible stock, in my opinion. If you were to buy and hold this one, you would get a nice dividend yield. You would get a nice dividend payout ratio of under 60. You know, they're reinvested into their company. This is a restaurant chain, Chili's and Italian restaurants. So it's not considered fast food. So this one, you know, it's in that restaurant category with IHOP and Applebee's and Chili's and all sorts of those restaurant chains that millennials, they like to blame that they don't like to eat at restaurants. They like to eat at fast food places. So do your own assessment, of course, and decide. Next stock we're going to be taking a look at is PEG, Public Service Entertainment Group. We're at 12 minutes, so I'm going to try and speed this up just a little bit here. Dividend yield, take away the dividend. So their price is very high compared to their yield, so really off the bat they do look overvalued at this time. Take a look at their 1 year and 5 year. 1 year they are up 10%, so right along with the S&P 500, actually beating it. And for the 5 years, up 48.8%. So this could be a really nice buy and hold. Its price to earnings is really high right now. But if you did buy it, say at a $41 range, it's had a lot of growth in the last 2 months. So if you actually had an entry point here at $41.81, you would have had a nice increase of around 12.5%. And probably a better price to earnings ratio than what's now being offered. And you probably would have gotten a yield of around 3.8, 3.9%. Actually 4%. So really nice yield for that buy-in time. Let's see here, what's next? Let's take a look at their dividend payout. Their payout ratio, so PEG. 5 years, so they did not pay through a recession. Their payout ratio is relatively okay, you know, under 60. They're reinvesting 40% of their earnings back into their company. This one you would buy and hold on Wednesday, and they would ex-dividends on Thursday. You get paid on September 29th. They have negative annual growth. What is this one? PEG. So PEG has negative annual growth. So meaning that they probably cut their dividend here, or they haven't been increasing. It looks like they missed a payment right here. After February, they didn't pay again until July. So they actually missed a payment there. So if you were hoping to get that pay, they did not pay you there, and they didn't make it up. They did do a 2-for-1 stock split, so that's pretty interesting that they even increased their dividend. Their dividend payout. Huh. Interesting. Oh, let's see. I want to look at 2008, that recession period. So they held 33 cents per share from 2009 until 2011. So 2 years they had no growth, but not terribly. Again, they had a stock split, 2-for-1 this time, so your dividend pay would have increased. You would have held this stock through that recession period, and you would have made your money back since the actually 2008 crash. If you bought near the midpoint prior 2006, but if you bought into the stock anywhere in 2007, 2008, you would not have seen your return yet. You may have seen your return. Actually, you probably would have, except if you bought at this top point on January 11, 2008. If you bought there, I'm sorry. The price to earnings is relatively high, 52.9. So not a good buy and hold stock for the long term. While it does have nice 1-year and 5-year growth, it's very high price to earnings. Dividend growth, it's not terrible. They've had decent dividend growth, and they have continued to pay out dividends through even recessions without cutting it back. Diversified utilities, so they can afford that. So that's PEG. KMB is our next ticker symbol, Kimberly-Clark. They're a multinational personal care corporation that produces a lot of paper products. Taking a look at this, they look undervalued right now. You can take a look at their price is the blue line, so their blue is currently sitting under the yield right now. So whereas their average price is probably $125 and their yield is 3%, their yield is 3.09%, and their dollar price is 122. Now if we add just the dividend in there and switch to the max, looks like they have had continued dividend payout growth for about 40 some years, so quite a long time. So this could be a good buy and hold stock. So let's take a look here. Let's see, it's a KMB. Take a look at its 1 year. Is it up? Actually, it's down 4.5% for the 1 year, and up 5 years 46%. So that averages 9%, a little over 9% per year average, which is higher than the S&P 500. Plus, you'd be getting a nice yield of 3.17 or higher, depending on your buy-in. If you bought it in this period right here, November and February, you would have got a yield of around 3.25%. So decent yield, especially for a stock that has had 40 some years of dividend growth. So KMB, let's take a look at its dividend growth here. It's going to amaze me. 44 years of dividend growth since 1973. Payout ratio is not bad. I like to have near 60 or under. This one, its dividend growth has a good indicator that is a good buy and hold company. They're reliant. They pay through recession after recession after recession. They have personal products, so paper products, those personal products, those consumer products, those don't go anywhere during times of need. Those are probably ramped up and are easily affordable. I know I see Kimberly-Clark items at Walmart quite often. So good buy and hold stock, and for the long term, good growth, decent payout ratio. Their PE ratio is under 25, so they're not extremely. Their price to earnings is actually not too bad right now. That would be something I would look at. Whether their what's their industry average. We can actually do that real quick. Let's just do that because this one has me sort of interested. This could be the #1 pick of the terrible 5x, the 5 stocks with ex-dividends next week. So KMB. And while this is loading, actually loaded pretty quick, let's go ahead and click on that. So what's our next stock? Our last and final stock is CATO, C-A-T-O, ticker symbol. Now this is loaded up. So their industry average is 66.94 or 16.86 in the sector. So this one, so if the industry is 66.94 and this one has a 20.45, that is very nice. For the industry average, 20.45, you're getting this at a really nice discount, getting a good dividend yield. You're getting what's considered an undervalued stock right now, comparing its yield to price. It's had 44 years of continued dividend growth, and a payout ratio of nearly 60% and under, meaning that they're reinvesting 28% back into their company to have those paper products pushed out always. Oh, we talked about their dividend date is on the 7th, so it's next Thursday again. You need to buy and hold on Wednesday. They don't have amazing annual growth, but heck, if you're holding this for the long term, you're going to see your initial investment double. So rule of 72, let's just do 72 by 4 is 18 years. So in 18 years, if you didn't put any more money, if you put $1,000 into this, it paid you $300 back in a year. No, what's that? What's $31? I can't do the math right now. If you put $1,000 and you're getting 3.17, I think it'd be $31. $3? Hold on. 1,000 plus 3.17%, $31. Okay, so you would get $31 per year for every 1,000 that you invested. My math, it's late. If you put 2,000, it would be double in that. You get $62 if you double that, and so on. So, but in 18 years from your initial investment, your initial payout would be doubled within that growth period. Because of the growth is 4.6%. We'll say 5. We'll just say 5. 72 by 5. I thought that's a quick 12. 72 by 5. 14.4 years, you would see your initial payout double. So good buy and hold, and then your dividends would be reinvested with DRIP if you want to have that enabled, which would speed up the process and actually probably cut this down to 8 or 10 years where you're more than double by then. So good stock overall. Last stock, KATO, 9.97% yield, very high yield, meaning if you put $1,000 into the stock, you would get roughly $100 back in dividend payout per year. But at the same time, look at the stock, it's falling even during this time where there's so many stocks out there that have had huge growth in the last year or since the election periods. This one's just been falling. So whereas this would, it looks like a nice value, but at the same time we don't know where it's bottoming out at, so could be a very bad investment. Along with its dividend yield, it looks like it had really nice growth for a good time, spiked up, and then was paying out $2.25 for that's probably a special payout, fell back down, and then have continued to have this little, if you just got rid of this line where it went up and went down and just join these two together right here, it wouldn't be so bad. Let's see if we can see if you just took this, pretend it's not there, and you just drew a line from here to here, it would actually seem like it's pretty not so bad. Let's go take a look at its 1 year and 5 year KATO stock. I spelled that wrong. Okay, 1 year is down in dumps 61%. That is huge loss. 54% in the long term. So again, if you bought this one right now where you think it might be bottoming out at, this, of course, it's a woman fashions and accessories. So this would be one that you might want to look into yourself, listen in the last earnings reports, see what the CEO has in store for this company. Are they going to be turning this around? Because if you're buying it at $13.22 and in the last 5 years it was at $44, $37 in that time frame, why is it so cheap right now? Why did they take it down so far? This could jump back up and you could get an increase easily of 40 to 70% if it jumped back up and went back up. Of course, that would be something you'd have to assess yourself. Listen in on those quarterly reports, take a look at its earned financials, and listen what the CEO has to say, who's been there since 1999, so he's been there for over 18 years. So just gotta wonder, what is he doing? Let's see here, KATO. See what its payout is, 78, so pretty high payout. Not apparel stores, I'm not sure if this is pretty normal. Earnings per share is $1.68, so they are profitable, of course. Dividend growth 7 years, but again, if we looked at that chart, and their dividend growth is 7 years, but they had a huge spike. This one, their ex-dividend date's on the 8th, so it's Friday. So you need to buy them on Thursday, hold, and you can sell off on Friday if they are, growth, or you can just buy and hold. They have had annual growth for 5%. And here, if you just took out this giant chunk here of $1 per share, and you just said 25 and 30, you took out this period here, they paid out a huge lump sum. So let's just take this 25 and 25, and 25 times 4 is $1. So basically they just paid up front for the year $1 per share, and then during the remainder of the year they only paid out 5 cents per quarter, but you already had your money, your payout in a 1 quarter payout. And then once those 4 other quarters ran through, they just kind of continued where they left off. Actually, they hadn't had any growth during this 2014, like 2-year period. They had no growth. To me, this wouldn't be a bad investment if you could catch this one at the bottom. Say you did buy in at 13.22 and it decided to jump up like Snapchat. I don't know what Snapchat. I'm not worried about that. Anyways. And it did kind of continue to rise up to even there's a 41% gain from going from 13 to 22 right there, just 40%. So this would be one kind of interesting to kind of look at. It's a billion-dollar industry. CEO has been in there for 18 years. This would just be one that I would need to look at and wonder why it's so low and cheap right now, even though they have had different decent payout. So of the stocks that we took a look at today, I believe Kimberly-Clark was the #1 pick. For the current time frame, it's undervalued. Followed right behind by CATO would be a decent one if the research was done on it. Followed right behind by EAT, possibly, depending on where the heck this thing stops falling at. And then kind of picked up, I wouldn't invest in WMB or Public myself. Those just look super risky. Look at the charts on this. So we're at 27 minutes right now. Long video. Hopefully you guys have stood still or continue to watch the video through. Of course, I do want to thank you for watching the video up until this point. If you did like the video, do hit the like button below, and do remember to subscribe for future financial videos. If you have any questions or want to say hello, please leave a comment and I will always reply. Is there a stock that's coming up in the future that you would be interested in having it going over and take a look at its information? Go ahead and leave that in the comments below. I won't be doing ex-dividends for the next 3 weeks. I'll actually be in Germany, so I will be out of town and out of country, so I will not have internet. Besides maybe random places such as Starbucks. So I may not be able to make videos, but I will be releasing some scheduled videos. So thank you for tuning in again, and I will see you next time. Bye bye.